Welcome to This Explainer. Today, we're jumping right in and dissecting the anatomy of a potential multi-bagger in the enterprise software space. We're going to objectively break down the business model, the intensely competitive landscape, and the underlying financial math behind a deeply fascinating company, Zeta Global. Whether you're heavily invested in marketing tech or you're just kind of curious about how modern, AI-driven data architectures are actually valued by Wall Street, we're going to unpack exactly how this platform functions under the hood.
$50 billion. Let that number just sit with you for a second. To put that scale into perspective, $50 billion is roughly the market size of legacy giants like Ford or Marriott. According to our source analysis, this represents a mathematically plausible terminal valuation for Zeta Global, assuming a very specific, highly aggressive growth scenario plays out over the next decade.
So, that brings us to the big question. Right now, Zeta sits at a market cap of around $5.3 billion. Achieving that $50 billion figure, that represents roughly a 10x multiple of its current state. And let's be real, in the enterprise software space, a 10x leap at this stage of maturity is exceptionally rare. It takes absolute flawless execution. In this explainer, we're going to explore the exact operational playbook required to hit that 10x scale, and just as importantly, the massive structural hurdles and uphill battles standing in their way. Here is how we're going to break it down today. First, we'll meet Zeta Global, then look at their dual revenue engine, check out the competitive landscape, dive into the structural friction and risks, and finally, map out that 10x blueprint.
All right, part one. Let's meet Zeta Global and take a quick look at their leadership and governance.
You know, a company's future trajectory is so often defined by the DNA of its architects, and the mix of talent in this boardroom is honestly pretty unconventional. You've got the aggressive, high-growth energy of a serial founder in David Steinberg, who's relentlessly driving the global vision. But then, that raw entrepreneurial drive is heavily balanced by the seasoned Fortune 500 discipline of John Sculley, yeah? The guy who famously ran Apple and PepsiCo, bringing decades of legacy enterprise experience to the table. Add in Chief Financial Officer Christopher Greener, whose background at IBM brings a rigid, highly structured approach to capital allocation. Together, this trio creates a founder-led company that aggressively pushes for 30% year-over-year revenue growth, while keeping a strict, almost corporate legacy eye on positive operational cash flow.
Moving right along to Section 2, the dual revenue engine, direct versus integrated.
To really grasp how this company is valued, you've got to think of their revenue architecture in two distinct buckets. The big bucket, making up roughly 75 to 80% of their income, is the direct platform. Think of this as the do-it-yourself software-as-a-service model. Enterprise clients log into Zeta software, use the tools, and pay recurring subscription and usage fees. Then you have the smaller bucket, the integrated platform, at 20 to 25%. This is the do-it-for-me, managed service. Here, Zeta handles the actual media activation, using their expertise to buy ad inventory across the internet on behalf of the client, and they charge a markup or performance fee for that manual execution.
Now, here is the absolute secret sauce to their valuation strategy, the massive contrast in profitability between these two buckets. Software is a beautiful business model because once you build the code, selling it 1,000,000 times costs almost nothing, right? That's why the direct SaaS side practically prints money with a massive 75% plus gross margin. The integrated side, on the other hand, operates at a much lower 40 to 50% margin. Why? Well, managed services involve real-world friction. Zeta actually incurs significant direct costs having to pay third-party media platforms and ad exchanges for that underlying inventory. Wall Street absolutely loves high margins, which is exactly why shifting revenue to the direct side is Zeta's top priority.
But here's the clever part. These two sides aren't fighting each other. They actually form a highly psychological sales funnel. Think about it. Ripping out a Fortune 500 company's entire marketing software stack is a terrifying prospect for any chief marketing officer. It's incredibly risky and expensive. So, Zeta plays it smart with a classic land and expand strategy. They lower the barrier to entry by having a new client start on step 1, the integrated platform. The client hires Zeta for a low-risk, managed media campaign. Once Zeta proves its value and delivers concrete ROI, the relationship evolves to step 2. The client upgrades to the high-margin direct platform, permanently embedding Zeta's proprietary software right into their core daily operations.
Okay, on to Section 3. Let's see how this builds a competitive moat against the biggest names in tech.
Look, the marketing technology sector is literally a knife fight, but Zeta manages to thread the needle against some of the biggest tech giants in the world. Against legacy enterprise clouds like Adobe and Salesforce, Zeta wins by bypassing the integration nightmare entirely. Legacy systems are often empty shells requiring you to bring your own data, whereas Zeta comes preloaded. Against mid-market software like Klaviyo, Zeta offers true global enterprise scale. And maybe most importantly, against the massive walled gardens of Google and Meta, Zeta positions itself as an independent rebel alliance. When brands use Meta, they're essentially just renting an audience inside a closed ecosystem. Zeta empowers brands on the open web, letting them actually own their customer data and interactions.
The absolute holy grail powering this entire ecosystem is their deterministic identity graph. In non-technical terms, this is a native, built-in database of over 240 million real, fully opted-in US consumers. Just think about the gravity of that number for a second. That is essentially every adult digital consumer in the United States, complete with their behaviors, buying intent, and demographics, already sitting inside the software. Instead of a brand spending months and millions of dollars trying to hunt down their target demographic across the internet, they simply log into Zeta and flip a switch. The audience is literally already there.
Which brings us to Section 4, structural friction and risks, the bottlenecks to that 10x dream.
To be totally objective about the likelihood of a $50 billion future, we have to look at the severe friction holding them back today. There's a deep structural tension here. The strengths are undeniable, right? A massive proprietary identity graph yielding blended gross margins safely above 60%. But the weaknesses are glaring. Roughly 90% of their revenue is tied exclusively to North America. If the US economy enters a localized recession, Zeta is dangerously exposed compared to globally diversified tech giants. Plus, despite phenomenal operational cash flow, they consistently post GAAP net losses. This is primarily due to heavy stock-based compensation, which essentially dilutes the pie for everyday retail investors to pay corporate talent.
But the real existential threat to their valuation is what analysts call the ad tech trap. Wall Street is incredibly rigid in how it prices companies. They love pure software companies with highly predictable, recurring revenue, rewarding them with premium valuations of 8 to 12 times their sales. On the flip side, Wall Street hates the unpredictable, volatile nature of advertising agencies, often valuing them at a measly 1 or 2 times sales. If the market decides Zeta is just a fancy ad agency rather than a true software platform, their multiple will compress and the 10x dream just dies. Add in the constant threats of government privacy regulations, the death of the internet cookie, and intense scrutiny from short sellers over data sourcing, and the path forward is a minefield.
Finally, let's hit Section 5, the 10x blueprint, and the actual math for a $50 billion valuation.
All right, take a second to absorb this raw financial data, because the sheer scale of this challenge is staggering. To build a $50 billion behemoth by the early 2030s, minor incremental growth won't cut it. Annual revenue has to absolutely detonate, climbing from roughly $1.8 billion today to an astonishing $8 to $10 billion. At the same time, they can't sacrifice efficiency for growth. They must actually expand their free cash flow margins from 22% up to a highly disciplined 30%. This combination of hypergrowth and aggressive margin expansion demands near-perfect execution over the course of a full decade.
So for these numbers to actually happen in the real world, a very specific operational revolution has to take place. First, their proprietary Athena AI has to evolve from a simple digital copilot into a fully autonomous enterprise agent, an AI capable of independently managing million-dollar marketing budgets without constant human handholding. That's a massive technological leap. Second, they have to ruthlessly steal 10 to 15% of the total global market share right out from under Adobe and Salesforce. And finally, they've got to run their land and expand playbook to the extreme, ensuring that high-margin SaaS revenue permanently eclipses their managed media execution to escape that ad tech trap once and for all.
In investing terms, our source material essentially maps out a classic asymmetric bet here. A 10x return is clearly an outlier, rocket ship bull case that assumes everything goes perfectly. But what's interesting is the downside risk is surprisingly cushioned by the sheer amount of cash the company already generates. Even if they totally fail to conquer the AI world and just stay in their current lane, compounding their existing growth could realistically yield a 3 to 4x base case over the next 5 to 7 years. It's a financial profile where the floor feels relatively stable, but the ceiling is just exponentially high.
So I'll leave you with this final thought to chew on. The operational blueprint is drawn. That 240 million profile data architecture is firmly locked in. But in a world where tech titans will spend billions to fiercely defend their walled gardens, can a prepackaged open web AI engine actually steal the crown? That is the $50 billion question defining Zeta's next decade. Thank you for joining this explainer, and we'll see you next time as we continue to dissect the frameworks shaping the modern business world.